Good morning, everyone, and welcome on our last IFRS webinar of this year. Next week, there's still a Finvision webinar planned on the Corporate Sustainability Reporting Directive. We will share more information on the planned CSRD webinar and how to subscribe for it later in this webinar. Today, we will deal with some cases from ESMA's enforcement database. Next, we will look forward to the ESMA priorities for the upcoming 2023 annual reports. And finally, we will also share with you information on the IFRS and ESEF updates to be expected in the coming years. Our speakers of today, my name is Anouk Meerschaert. I'm a manager in the IFRS and Consolidation Service line, and I'm in good company today of my colleagues, managers Hans Everaert and Andres Hennebel. The logistics for the webinar: all participants are automatically muted. The webinar will last maximum 1.5 hours. Questions can be asked through the question pane in the GoToWebinar app. The slides are also available in the handout section of the GoToWebinar app. The webinar will also be recorded and be made available afterwards on our website, and you will receive a poll to evaluate the webinar. The agenda for today. First, we'll go through the latest published ESMA report on database enforcement, which contains the decisions taken by national enforcers in the period from June 2022 to July 2023. Then we look forward to the focus points that ESMA has set for the 2023 annual report. This contains priorities on 3 sections: IFRS financial statements, also non-financial statements, and other considerations related to alternative performance measures and ESEF requirements. Finally, we have a look into the future IFRS updates and amendments to be expected, and thus the ISB project plan. In this topic, ESMA report on database enforcement, we will walk you through some cases from the ESMA's enforcement database that will give you some insights into how the enforcers reviewed issuer publications in the past and what enforcement actions they have taken. On this slide, you see the list of items that have been included in the 28 extract of the ESMA report on database enforcement, which was a report that has been published in October of this year. The topics in green will be dealt with in this section, and the 2 items in blue will be integrated in the ESMA 2023 priorities section, as those can also be linked to items that will be part of the priorities for 2023 as well. The first case is one on earnout payments related to business combinations. What were the facts in this case? We had an issuer. He acquired 100% shares of a company, Company A. 25% of the consideration was fixed, and 75% of the consideration was dependent on future financial results. So it was a contingent consideration, a contingent payment. But in addition to receive the 75%, the vendors of Company A could not voluntarily leave employment. What was the issuer's view in this case, and how did they account for it in their annual report? The vendor's obligation to continue working for Company A, according to the issuer's view, lacked economic substance. They argued that the vendors would only forfeit a contingent consideration if they voluntarily left the company. And in addition, they said, well, after acquisition date, some vendors reached an agreement to terminate their employment without having lost their earnout rights. A third argument that they used in the annual report was that the vendors did not sell the shares to the issuer directly because the shares were acquired via a holding company, but the vendors were 100% owner of that holding company. So their view was that the earnout was considered part of the acquisition price. So it was considered as a consideration for the business combination itself. The enforcer in that case disagreed with the argumentation. They said a transaction that remunerates employees of former owners of the acquiree for future services, that is likely to be a separate transaction. So it's likely to be, not sure, but likely to be a separate transaction. And they also based their argument on a publication that was done by the Interpretations Committee in January 2013, which stated that a contingent consideration in which payments to an employee are forfeited upon termination is in fact a remuneration for post-combination services. So here, the enforcer argued that the earnout should be considered as a remuneration for post-employment services, and not as an acquisition, a part of the acquisition price. The fact that the shares were acquired via a holding company did not change anything, according to the enforcer, to the economic substance of the transaction. So there was no, that was no valid argument. In a second case, it's also about a business combination. And here it was the classification of a put option liability and the measurement of that put option liability related to a business combination. The issuer in this case acquired 51% of the shares of a Group A. The acquisition was a business combination, which was within the scope of IFRS 3. There were two Group A founders that retained a 49% NCI, non-controlling interest, minority, and they became also employees of the new group. The two minority shareholders, they received put options to sell the remaining shares to the issuer, and that would be as follows: 29% would become exercisable in 2024, 20% would become exercisable as of the end of 2024, or when the founders left the employment, so at the earlier of both dates. The exercise price included a discount in case the vendors left the group. What was the issuer's view here? Well, they recognized the financial liability for the put options granted, and at the recognition date, they measured the financial liability, taking into account the full exercise price of the option. So they did not take into account, they did not consider the discount. In this case, the enforcer, they partly agreed, but partly disagreed as well. They say, okay, financial liability should be recognized when an entity has an obligation to pay cash in the future to purchase minority shares, even indeed if that cash is conditional on the option being exercised by the holder. But in this case, part of the financial liability would only be due if the original founders do not leave employment. Then they used the same arguments, in fact, as in the previous case. They said, okay, a transaction that remunerates employees is likely, employees or former owners for future services is likely to be a separate transaction. And again, if that consideration is forfeited upon termination of their services, then it's a post-combination service or a remuneration for post-employment services. So they agreed that it should be accounted for as a financial liability, but corresponding to the estimated exercise price of the put options reduced by the discount. So they did not agree with how it was measured. It should not be at the full exercise price, but at the exercise price, including or considering the discount. And it should also be accounted for as remaining contingent payment, as a remuneration expense, as an employee benefit over time on a pro rata basis, because it's in fact a consideration for the remuneration for post-employment, post-combination services. The third case that was discussed in that report was on the recognition and measurement of distribution rights. Here we have a telecom service provider, and a telecom service provider who is the issuer entered a 5-year contract to acquire non-exclusive rights to broadcast specific sport channels owned and developed by a supplier. They have the right and also the obligation to display the channels, but they have not the right to edit or to resell the material. For that contract, they pay a distribution fee, and that is a fixed fee per season. So each year they pay a fee in 2 installments. 70% of the fee is payable in August, 30% was payable in January. The issuer here recognized for the total amount of the fixed fee of 1 year a non-current intangible asset. They did that each time in August. They recognized the fee for 1 year as a non-current intangible asset that is then subsequently amortized over the duration of the season, so with the depreciation through P&L, not impacting EBITDA. The amount to be paid in January was recognized then as a liability to offset with the remaining part for that non-current intangible asset. In this case, well, the enforcer agreed that they have a right and obligation to display content. And there are 2 views, in fact, with regard to the nature of the underlying resource that is controlled by the entity. And those 2 views, or the difference in the 2 views, is essential here. So in case the underlying resource is the IP, whereby the producer owns and controls and the distributor does not, then you should not recognize it an intangible asset. But in this case, and there the enforcer agreed, the underlying resource is the right to broadcast. So the control over distribution over the contract period leads, in this case, to a recognition of an intangible asset, and the identifiability of that asset arises from contractual rights. There is a 5-year contract. So they agree that you should account for a non-current intangible asset because the issuer had a right to display the channels, and also other market participants could be restricted from controlling the benefits of those distribution rights, because if they would like to acquire that right, they should pay a similar price for that. The moment when that should be recognized, also there they agreed in this case that it should be as of August, because you can recognize the distribution rights when sufficient details about sporting events were known. So the exact number of sport matches that would be displayed, the when and where the sport matches would take place, the teams that would compete. So that is the time at which you would recognize that non-current intangible asset. However, they disagreed with the fact that in this case, the issuer only recognized it for the payment of 1 year. They say you have a 5-year distribution right. It's a contract of 5 years. So you have a 5-year contractual obligation and a 5-year contractual right. So as from the first year, you should already recognize that 5-year distribution right, since the asset is controlled by the entity, and then you also record for a liability for the remaining payments. There was also a case on a lot of control. Here, what are the facts? The issuer established a 100% consolidated subsidiary, was Company A. The purpose of that company, that was to construct and lease out a building to a government body. In November 2017, the issuer signed a contract to sell 60% of the shares of that company to an external party. The risks and rewards were transferred to the acquirer after completion of the building construction. So in fact, you have 2 phases, a construction phase and then the leasing phase. And it's at the point that risks and rewards are transferred to the acquirer, that is the starting from the leasing phase. The issuer was responsible for the finalization of the construction, and it would even incur penalties if the construction was completed behind schedule. The construction itself was eventually completed end of 2018. So that's 1 year after that the issuer sold 60% of shares to the external party. In this case, the issuer deconsolidated Company A already at the end of the reporting date in 2017, so after signing the contract. It argumented that they lost control as they had no longer substantive voting rights and the power over the relevant activities, and they considered the relevant activities to be the construction, but also the subsequent leasing of the building and financing of the construction. They said that the acquirers were granted rights to approve material future business transactions and activities, and they could only undertake, so the issuer could only undertake major investments, financing, and personnel decisions in consultation with the acquirer. Also, the sales contract and the sales of the shares did not significantly impact the construction contract that was already there up in the moment of the sale, and that was signed between the issuer, who is responsible for the construction, and Company A. In this case, the enforcer disagreed again with the issuer. They say, okay, you have relevant activities over the company, but those relevant activities differ during the construction phase compared to the leasing phase. The relevant activities during the construction phase is the construction of the building, and that is something that you as issuer are responsible for. So they, the issuer, directed the relevant activities during that first phase. The enforcer also argumented that the rights that have been granted to the acquirer were more protective rights, substantive protective, in substance protective rights, just to ensure that the construction agreement, which the issuer must fulfill and for which they are responsible, was not altered during that period. So one element is already fulfilled in the definition of control, and that is they have the power. They have the power to direct the relevant activities. Another element in the definition of control is you should be subject to variability in returns. And also there, the enforcer said, well, that is the case. You as issuer, you are subject to variable returns because you can incur penalties if you have a delay in the construction. So in this case, well, the conclusion was that you should not have the consolidated company A at the end of December 2017, but that you should keep it into your consolidation up to the moment that construction was completed. And in this case, that was end of 2018. Another case where it's also about control, but in this case, the assessment of whether we have control or not over a certain company. The issuer held a 45% interest in a construction company in the Middle Eastern country, which had an LLC, so a limited liability company, as a legal form. The information was that prior to 2016, the company A's management board consisted of 3 members. Each one was representing company A's shareholders. So one of the issuer, one of shareholder B, and one of shareholder C. What happened then in 2016? The shareholder C sold its interest to B. It sold its share interest to B. There was a specific element here because under local law in that country, a national of the country in which the company was located must own at least 51% of an LLC legal form. Shareholder B was in this case a citizen of the country where the company was located. So that was why they decided that company shareholder B acquired the share interest from C. But on the other hand, it was the issuer who took over the loans, the guarantees, and all similar obligations to company A from C. So in fact, the issuer in this case took over all the substantial risks that were related to company A. What was the situation thus after that transaction? That is that shareholder B held a 55% interest in the company. And moreover, the issuer received a purchase option for all of the shareholders B shares. So there was a purchase option to acquire, in fact, all the shares of the company. The number of the management board members held by the issuer was also increased from 1 to 2 out of 3 board members. So the issuer in this case had 2 board members out of 3 in the management board. We also have additional information on board decisions. So the resolutions of the management board required a majority vote of the present board members. And there were some board reserved matters. Those board reserved matters required an approval of the board members that were designated by both shareholders. So in that case, the issuer and shareholder B. And what were those board reserved members? It related to adoption of the business plan, approval of transactions that were outside the business plans. There was also a deadlock procedure where then in case of a deadlock procedure, it would go to an independent arbitration board to decide on the agenda and the decisions and the points that should be decided on. The managing director to be appointed by the board was also proposed by the issuer in this case. And then another element that is relevant to look at this one is that the purchase option on the remaining shares of shareholder B could be exercised at any time. There was the shares would then be transferred within 45 days. And the price was contractually specified using a calculation as a multiple of EBITDA. What was the issuer's view here? Well, the issuer concluded that they did not have control over company A, but they assessed it as joint control. So joint control together with shareholder B. What were the arguments that they used in that view? Is that the purchase option, according to them, did not result in a substantive right because of, they argued, the 45 transfer days of the shares. The approval of the board member of shareholder B was also required for relevant activities because one of the activities there was the business plan, and they assessed that as one of the relevant activities over the company. And they also argued that there were share transfer restrictions imposed by local law because of the fact that it should be a national from the country. So the issuer in this case, in their argument, could not hold more than 49% of the voting rights. Again, here the enforcer disagreed. They said, okay, we are okay that you say that the approval of the business plan is considered one of the relevant activities over the company, and this also impacts the variability in returns. But was their argument, you should also look at other rights and risks that are associated with it. In this case, there was for them kind of favorable purchase option over the shareholders' B shares. It was exercisable also at any time. And by exercising the purchase option, the issuer could even resolve a deadlock relating to the relevant activities, because they then would have all the shares and thus they can decide on their own on the relevant activities. Also, the asymmetric risk position was one of the elements that was very strong in the argues of the enforcer. They said, well, the greater the exposure to risks is with one investor, the more likely it is, or the more this indicates that power is with that investor. And in this case, we as an issuer, we received all the loans and guarantees from shareholder C. We did not receive the share interest, but we received the loans and the guarantees. So in fact, all the risks. Moreover, they said, yeah, the purchase option is substantive in our view, because it could be exercised at any time if needed. There were no restrictions to that. They say, okay, the fact that local law requires a 51% share at national of the country, that is not to be considered, because you could, as an issuer, replace shareholder B by another shareholder that votes always with you in the decisions. So decisions would then, in that case, be made by the issuer, in fact. And exercising of the purchase option would even be beneficial, because then you resolve a deadlock procedure. So their conclusion of the enforcer was the issuer controls the company, it's not joint control, and thus you should take it up as fully consolidated as of 2016 already. The last but one case here is on principal versus agent principle. Principal versus agent. The issuer in this case is an IT provider. It offers products and services, and that includes also the sale of standard software licenses. For those software licenses, the issuer has non-exclusive rights to resell the software because of an agreement with the software developer. According to that agreement with the software developer, it required the issuer to provide pre-sale advisory services to ensure, in fact, that the customers received a suitable solution and purchased sufficient licenses. So it was also a commercial aspect. The pre-sale advisory services did not create an obligation for the end customer to purchase the software license. So there was no obligation at all for the end customer. It was just in the agreement between the issuer and the software developer. The issuer, in this case, had complete discretion in the price setting. The payment to the software development was also not contingent on the payment from the end customers. And it was the software developer who had to assure the functionality of the software. The issuer, in this case, considered itself as a principal, and it recognized revenue on a gross basis. And what was their argumentation to do that? Well, they considered the specified goods and services as a bundle, so as a one single performance obligation, so to say, of the software license and the pre-sale advice. They said the software license cannot be acquired without a pre-sale advisory service. And they considered that also to be a significant service of integrating the software license with the consultation into a combined output being the one suitable software solution. They considered also the software license and pre-sale advisory services as highly interdependent and interrelated. So here they concluded is a single PO, a single performance obligation, and it concluded that it controlled the specified goods or services provided to the customer before they were already transferred because of that pre-sale advisory service, and thus recognized it recognized revenue on a gross basis as a principle. Here the enforcer disagreed again. They said, well, the pre-sale advisory service and the software license are considered two distinct performance obligations. Why was that? Because the pre-sale advisory service was performed before the customer even decided whether to buy the software license. The pre-sale advisory service was something just between the issuer and the developer. The end customer had little or nothing to do with that. It was more to ensure that enough licenses were purchased. So it was also in the interest of the developer itself. That pre-sale advisory service was also not a significant service of integration. It did not alter the software license itself. So in that case, the enforcer argued that the issuer acted as an agent of the software developer. It was the developer who was primarily responsible for providing access to the software and its functionality. The issuer also had insignificant inventory risk. And the right to use the software arose only when it was granted to the customer and not upon the pre-sale advisory service, because the customers were not obliged, as from that moment, to purchase the software license. So the issuer in this case had to recognize the software license on a net basis, thus as an agent. And then the last case we discussed from the enforcement database is with regard to disclosures related to leases. This is a more straightforward case. The issuer was an IT and management consulting company. It recognized in its statement of financial position right of use assets, those assets related to office premises and also vehicles. And the right of use assets represented more than 10% of the total assets. In 2021, the issuer then signed a new lease agreement that related to new office premises. It sold the former headquarters. And that new lease agreement represented more than 90% of the right of use assets in total. It did not mention anything in their 2021 financials regarding additions to the right of use assets, nor to the total cash outflows for the leases, because they said that was the issuer's view. We provide already information on the depreciation charge of the right of use assets, on the interest expense on lease liabilities, and on the low value leases. So in their view, that information was indirectly providing the user with a reasonable picture of the cash outflow of the lease and the additions of the right of use assets. There, the enforcer was clear that according to paragraph 53 H and G of the IFRS 16, a lessee should disclose cash outflows and for leases and additions to right of use assets, and both amounts were material. It consisted of more than 90% of the right of use assets, so materiality was no valid reason here. And by not disclosing that information, they said, well, you do not enable users to compare investments in leased and owned assets or to forecast future lease payments. And that's why you should disclose that information. This was the ESMA database, enforcement database. We will now move on, and I give the floor to Hans, who will move on to the ESMA 2023 enforcement priorities.
Thank you, Anouk. In the meantime, a question came in whether these enforcers' views are mandatory to follow by each issuer, yes or no. Whether it's legally binding or not, we are not fully certain, but anyhow, it will always depend on facts and circumstances highly, and at least it gives an insight in how enforcers' point of view is, how is the interpretation. Also note that it's not the ESMA that is doing the enforcing, it is at national level. So for example, in Belgium, it is the FSMA that is there. So at least the point of view of interpretation of the enforcer is clear. The ESMA is bundling them, so all enforcers at a European level are also aligning over time by bundling this and having discussions among the ESMA. So moving on to the 2023 enforcement priorities. First, what is the definition? It's a bit, as I said, the ESMA publishes a list of issues and attention points on a yearly basis, and the regulatory authorities, as I just explained, in case of Belgium, the FSMA, will focus on these points during their reviews of the company information. Those together are the European Common Enforcement Priorities. And then, as just explained by Anouk, afterwards they will report back on that based on the examinations, what were the key findings they had, what was the key actions taken by the enforcers, and they bundle them together. Having a look back, because obviously those priorities do not necessarily change every year. As you will look in 2021, there was still the focus on COVID-19 impacts. There were climate-related matters, expected credit losses, and taxonomy-related disclosures. When we moved to 2022, the COVID went out because the impacts were lower, but obviously the invasion of Russia into Ukraine came in, but climate-related matters were still in, although obviously those topics, and I will come back on that later, is evolving over time. Macroeconomic environment came in, giving changes in discount rate and the overall macroeconomic environment. Taxonomy-related disclosures was obviously important evolution last year, and then also reporting on scope and data quality. Focus points for 2023 still remain climate and other environmental matters, but obviously context is changing. First of all, there is further evolutions. There is recent decisions taken as of today even. So the context is changing of climate and other environment, but also companies are further in the process of making the assessment, so have more information, or should at least have more information available that could help them to make relevant disclosures and give other insights that were not yet available 2 years ago or 1 year ago. I will go more in depth on each of those topics further in the slides. The macroeconomic environment is still a relevant point, but for example, this year will be focused more on, by example, the increasing discount rates, whereas other focus points were still there last year. Identification and consistency of APMs, and then the ESEF block tagging, more impacting last year, smaller updates this year. Going deeper on the climate and other environmental matters. Just for your information, we will go here on the focus point that the ESMA is expecting, but on the practical application and more in detail application of CSRD, we have a webinar planned next week, where first there will be a brief refresher, more in depth as I will do now, on what is CSRD and who should specifically apply it. Then there will also be a testimony from somebody applying and working on the CSRD using a tool. And then finally, they give also an insight on the person responsible for their tool on how it could help you in the end-to-end ESG reporting process. If you have any specific questions on that, my colleague Michiel, who will be leading this webinar, is gathering all information and questions, and if it's bundled there, we can come back on those questions next week. Looking back to what is the priorities from the ESMA's point of view. So as said, the climate-related matters were already there in the past. There is a bit focus points are shifting. Like last year, the power purchase agreements also came in. And also here, the ESMA has made a publication on examples where they looked at financial statement of 2022. What is relevant disclosures to consider there, both in financial information and non-financial information. And I said, and it will come back later, consistency between both remains important, especially because more information is available for issuers. So publishing that, you should make sure that you remain consistent in what you publish in your non-financial information versus the financial information, and obviously also vice versa. Typically, examples are significant judgment, and they could example lead to useful life that becomes shortened because of CO2 emission targets that are more strict, which leads to the fact that, for example, a specific machine will be used for a smaller time that was initially anticipated. Sensitivity analysis, which might lead more broader sensitivity ranges. What is the impact of your CO2 emissions? If rules become more stricted, will you need more CO2 emission rights than you have available? Should you buy additional CO2 emission rights? What will be the price you will need to pay? Those can all be judgments, and that could require more disclosures there on judgments and uncertainties. Also, similar topics coming back on, for example, impairment analysis. We have clearer this year, and it will come back later in the macroeconomic environment, increasing discount rates. But your impairment analysis will also depend on, for example, what cash flows will you need to make sure that you reach your climate-related matter targets you set for yourself. So if you set in your non-financial information specific target, make sure you include those cash flows needed to reach those targets also in your impairment analysis. Overall useful lives of tangible or intangible assets could be affected. Provisions might be needed if you need to acquire more emission rights than you have available to ensure you comply with the regulations. You might need to account for provisions on that, and so forth. So goal is to prevent greenwashing. You should be clear on your commitments to the targets. So most companies are further in the process, so commitments and targets will become more clear. Then the ESMA requires you to disclose those commitments clearly. Explain exactly where are you at this moment, what is the current status, what are the current actions taken, and what are the further milestones planned. What are the accounting policies you apply for each of those steps? For example, emission trading schemes, renewable energy certificates, are you buying them additionally? Do you have them available? How do you account for them? Will they come as an inventory purchased, or do you create them yourself by having green power installations, which entitles you to obtain renewable energy certificates? What is the financial impact of those plans, investment and transition plans? Are you using any deviation between the assumptions and the impairment test? And also disclose the emission trading schemes and the impact on your financial positions. Clearly, and its repetition, consistency between all information disclosed and made available is important. Key focus point, useful life, but it could, for example, as well be expected credit losses. Later on, we will see it's for the banks, also an important one, but it could as well be relevant for an industry company as well. So it's not new, but the focus is consistency and also having available more information available. You should be able to make more relevant and more specific disclosures than, for example, was made in the past. Make sure these are entity specifics and also have a time horizon where you indicate when you will reach a final conclusion. Best practice for the ESMA is to include everything in a single note and not spread over different parts of the financial statements. Focusing on impairment of non-financial assets, and it's also referring back to what we said, make sure you have reasonable and supportable assumptions that take into account every information available, for example, related to climate-related matters, but also related, for example, to what you will need. The management best estimate should have a range of economic conditions and a relevant remaining useful life. As said, what will you use as assumptions for CO2 prices? You might need to disclose that if it's material, it has a material impact. What is the timing and amount of replacing of certain assets? Are you basing yourself on internal estimates or are you using external sources? What are the cash flow impacts for the periods beyond the business plan? If you need to reach CO2 targets by 2040, then obviously that's beyond the typical 5 years prescribed by IS 36. How do you consider there? Do you make additional corrections there in your perpetuity, knowing that after 5 years there will be additional restrictions to consider? What is the discount rate and growth rate? Can you still continue a growth rate if you have specific targets to reach for CO2 reduction or other reductions of exhausts? Or should you make a limitation or cap on that, on your growth rate, knowing that your current asset base and the applicable CO2 reductions, for example, might limit your growth possibilities there as well. Power purchase agreements, 2 focus points. One is what is the relevant accounting treatment? One insight is IFRS 9. Do you have potential embedded derivatives to consider in your power purchase agreement? Yes or no? And or can you make use of the own use exemption there? I will come back in a further slides on a specific case where the ESMA considered last year and where the own use exemption was accepted, but facts and circumstances should be reviewed for your specific case whether you can make use of the own use exemption, and you also make available sufficient disclosures on that that support the position taken, being the own use exemption or not, or having or not an embedded derivative available in your power purchase agreement. A second important consideration could be whether your PPA, hereby being power purchase agreements, potentially includes a lease. And then we fall back on the parts that we explained last webinar as well on IFRS 16. Do you have an identified asset, for example, a specific windmill or a solar park? Do you potentially have substantially all benefits obtained and the power to directly use? And for what purpose? If all of these parameters you have the answer yes, then potentially your power purchase agreements includes a lease and would require you to apply IFRS 16 lease accounting there as well. Next to the decision on what accounting treatment, you should have sufficient disclosure. First one on the applied accounting treatment. So readers of your financial statements understand what is the accounting treatment applied, being IFRS 9 or IFRS 16, and what considerations or estimates and judgments you made there. But also on what are the price terms? Is it fixed or is it variable? What are the volumes of energy contracted? Is it all the output of the windmill or is it a part? Is it a virtual PPA or is it a physical? Being, do you take off all energy produced by that specific windmill, or is it based on the output of that windmill, but can it come from anywhere else, the electricity, for example? What are the objectives for the company, which links back also to the own use exemption a lot of time? Is it really needed for the electricity, for example, you need in your own production facility? Or do you have a power purchase agreement that has an output which exceeds your own needs, which will be relevant in the application of the own use exemption or not? So what are your objectives? Should be included in your disclosure, and also the duration of the power purchase agreement. In fact, here on a review done by an enforcer last year, so the fact was there was a supplier of natural gas that signed subsequent to year-end several PPAs, and the commitments were material as of closing date. Issuer also referred to its contract in its management report, so also the non-financial information, referring to it as its strategy in actions to reduce the scope of the CO2 emission rights. What was the issuer's view? It disclosed the accounting treatment, also stated that they used the own use exemption and applied it to the contracts. And the fact was also that none of those PPAs were included under structure entities or corporate wrappers. The issuer did not have any shareholder rights in the suppliers, nor variable rights to returns, which could potentially revert to control. And also the purchase power agreements were not linked to specific assets, and also only a small portion of the commodity produced by the supplier was acquired. That led to the fact that all electricity was consumed, and no net settlement was foreseen either. So the enforcer agreed with there, so they concurred with the issuers. Also, and because of all the information disclosed, being every electricity purchased was indeed consumed, which is relevant in the use of the own use exemption. Nevertheless, the issuers' commitments differed significantly from the contracts capable of being settled in net and cash. So the enforcer, although they did concur with the issuer's point of view, they did have some comments to make there, which is relevant to consider. Accounting for emission trading schemes and renewable energy certificates is also a focus point of the ESMA. So provide information on what is the specific accounting policies you use for the recognition, the measurement, and presentation. It can be relevant whether you produce them themselves, and then the question is, how will you account for it being as an intangible asset or being as inventory, for example, and following the relevant standards for intangible assets and for inventory, you might come to another valuation that needs to be considered. So be clear in your financial statements on what accounting policies you apply and how you come to the valuation of it and the recognition or derecognition of those for example, renewable energy certificates. Similarly, for emission trading schemes, do you have sufficient CO2 rights available, or do you need to acquire additional CO2 rights? What price do you use? How you come to the valuation of them? You should explain how do you come and the impacts your financial performance and your financial positions. What are the specific line items that are affected by those emission trading schemes, and where are the ethical differences and impacts across jurisdictions? If, for example, a group where the rules are different in different jurisdictions where you operate. What are the amounts of greenhouse gas reduction credits you have available? What are you owning? What are you consuming? What are you selling? Or, and that's the last bullet point, where do you need to account for provisions because you will need more greenhouse gas emission rights than you have available currently? Other special consideration for financial institutions, but potentially could be relevant as well for industry companies. Information on engagements in green financing, ESG index loans. There is a broad range of green loans becoming available, but what are the relevant information there available? And what are the potential exposures you might have? And what is the significant accounting judgments you made there? Another important part to consider could be what is the impact of climate risk becoming on your expected credit losses? Probably more relevant already for banks and financial institutions or insurance companies, but it could also be relevant for an industry, depending on what sector you were working. Attention points then from a macroeconomic environment. Considering increasing interest rates, it will be relevant to consider your risk and disclose them. Obviously, for highly leveraged companies, the impact might be much more relevant given increasing interest rates compared to last year. Not only for those relevance accounted for already in your financial position, but it could also be relevant for off-balance sheet disclosure where you already have loan commitments for the future that are disclosed, which are becoming more important given higher interest rates that exist currently. You should be able to disclose how the macroeconomic environment affects your risk exposure and how you're managing those changed risk. If you're looking at the sensitivity analysis of, for example, interest rate, how will that impact? If in prior years your sensitivity went for ranges for 0.5% because interest rates were lower, it might be relevant to give broader ranges. Obviously, others might say we have already had an increase. Will it still increase further? Sticking to the 0.5%, I think is less difficult to defend, given it might still go up. It might not go up full 4%, but it might still go up 2%. So considering your facts and circumstances, consider what is a relevant sensitivity range I will disclose and include in my financial statements. Also, they're important to consider what is your abilities to still meet all the covenant requirements. Being from an asset base, if you have covenants related to your assets that might be valued at a lower value given impairments, for example, also from an equity base where you might end up with a lower equity because of an impairment or because of higher interests you're paying. And I will refer further to an amendment upcoming in 2024 that will be explained by my colleague Andres, which is relevant to consider because the assessments made under current ES1 rules might be different than under the amendment that will become applicable in 2024. If that is the case, you might consider early application to at least allow consistency. It will be a case by case, but Andres will come back on that later. Also important is to consider your liquidity risk. Your maturity analysis should include undiscounted cash flows, not only for the principal, but also for interest payments. And if the interests have gone up and you have a variable interest, then you will have to include higher undiscounted cash flows, take into account the current higher interest rates and not the lower interest rates that were there last year. Collateral links back to what I said in the previous slide. Your liquidity risk might have increased because your collateral is lower. here, for example, because you had margin calls on your derivatives. So provide quantitative and qualitative disclosure how you manage those changed liquidity risks. Also explained by the ESMA, take into account whether you have a change in your risk concentrations resulting from changes in your assets, because you might have higher expected credit losses or liabilities, you have higher customer deposits. What are the specific agreements in place that are relevant? Your risks related to factoring might have changed because changing environment limits your possibility to draw from your factoring agreement and so forth. Decreasing cash flows might also require you to seek new debt or amended changes in your existing debts. So provide transparency on whether you're negotiating or what have you renegotiated on your existing debt, or have you been able to secure new debts and so forth. Hedge accounting, change in the macroeconomic environment also can impact your hedge accounting requirements. Are you still able to apply hedge accounting? Do you still have sufficient correlation? Or even if you can apply hedge accounting, your hedge ratio might have gone down because they're less effective than was the case in the past. You might need to consider an increased risk of your counterparty, which might require you to discontinue the application of hedge accounting. And then if you discontinue hedge accounting, make sure that you follow rules set by IFRS 9 on how to work further with what was built up in your OCI. If you have unanticipated withdrawals, does it change your macro hedging relationship? And can you still apply hedge accounting there as well? And also, aside from accounting impact, provide sufficient disclosures. What is the effectiveness you considered for the closing at that moment? Have you provided information on discontinued hedging relationship? And how does it fit into your risk management strategy? It has always been important for hedge accounting to have sufficient disclosures available, but if circumstances changes, your disclosure might change as well, and it might impact your ability to apply hedge accounting, yes or no. Here again, there was an example available in the ESMA database of last year. So it was a case where eventually, so the issuer was a travel and transportation company, and it hedged its variable interest rate to become fixed. The nominal derivatives contracts had a hedge relationship of approximately 80%. Issuer noted that we have floating rate loans with relevant months of Euribor rate. They used interest rate swaps to reduce that floating risk and turn it into a fixed interest, and the issuer applied hedge accounting accordingly. It provided also some brief information there that what was their goal here as well, but no further quantitative or qualitative relationship was provided, disclosing information on the specifics of those hedge relationship. What was the enforcer's view? There, the enforcer required to improve your disclosures regarding the cash flow hedges to enable the users what is the nature and the extent of the risk, and how are you hedging that risk with the financial instruments you contracted for. So both the nature and the extent of the risk, but also the nature of the hedge risk. What is the entity's risk management strategy and how do you apply it? And explain how it links back to the risk and the hedge instrument you're using, which allows you to come to hedge accounting that is applied. Also, the enforcer here noted that also they disclosed a hedge ratio of 100%. Looking at the underlying documentation, the hedge ratio only was 50%, which obviously indicated a too high hedge ratio being applied. The issuer, in the enforcer's point of view, had not provided sufficient information in detail that links back the entity's hedging activity on the amount, timing, and certainty of the future cash flows. And also, they required to indicate more on how they determine the economic relationship between the hedged item on the one side and the hedge instrument on the other side. So key always has been for hedge accounting, but is again stressed by the ESMA, is make sure your disclosures are sufficiently broad and also tie back to the hedge accounting and the parameters you apply in your hedge accounting. Other attention point for the ESMA is if you are using fair value measurement, make sure your disclosures are adequate as well. If you're using external experts, for example, in investment property, in real estate, it doesn't exempt you from providing sufficient details. So even if you have an external expert report available, you should still disclose the inputs used there, capitalization rate, rate of return. What is the process? Whether you apply different valuation methods and then come to an overall assessment. Given increasing discount rates and lower transactions that are available in the market, you might have less comparable transactions available in a recent period, which makes your evaluation or estimate more judgmental, and it can be relevant to include in your estimates and judgment. You might need to consider additional valuation methods to make sure that these are relevant and sufficiently stable. And the issuers are encouraged to provide more sensitivity analysis or broader ranges of your sensitivity analysis keys inputs. If you're changing your methodology, make sure you explain them sufficiently so readers are able to understand how you derived your fair values in current closing, and that is different from how you derived them last year. Also not new, but still relevant to consider are the alternative performance measures. So you need, and it's a repetition of the past, you need to be consistent over time, be also consistent in different documents you use. So for example, financial and non-financial information. Make sure you have the reconciliations available of your APMs to reconcilable line items or subtotals presented in your financial statements, and avoid the use and do not use non-recurring or special items to be separated. Andres will also come back on there as well, because a new standard is going to be released in the next years. IFRS 18 that goes also on the management defined performance measures as well. But more on that later by Andres. I now give the floor to Andres, who will go further on ESEF block tagging updates.
Yes, thank you, Hans. So actually, ESEF block tagging update in terms of the European Common Enforcement Priorities, it's similar to the APMs. It's mostly nothing new compared to last year, actually. Just to recap rather quickly, European single electronic format became first mandatory for just the tagging of the primary financial statements in 2021. The year after that, we had the text block tagging of the notes. So that was a large new requirement. For this year, actually, 2023, there are no major changes in the taxonomy or in the legal requirements. What do we have? That's an updated ESEF reporting manual released August 2023. The link should be clickable here in the PDF file. We received confirmation that the monster tag, the disclosure of notes and other explanatory information, is not mandatory anymore. And actually, the main ESEF priority that is being given is readability of tagged or extracted information from the XBRL reports. So I refer to the ESEF reporting manual, I think paragraph 2.2.6. And especially the table formatting, which was rather a technical challenge for some of you last year. In summary, what hasn't changed, but that paragraph explains, is actually also for tables, present words and numbers should be in the same order and be human readable. That speaks for itself. It should retain spaces between words or text blocks, but obviously information from presenting something as a table, that is something that we would not like to be lost, let's say. And just these are two of our slides of last year. I think we had technical limitations. If you just look at the XBRL's instances, you copy it to Excel, you get the item on the right there, human readable in Excel, but it doesn't show too much information. What it ended up like last year is actually on the left here, the HTML view. It is readable for all us humans. Then we have the XBRL tag from the inline viewer, let's say, you see some text, but on the right you see that actually the value from presenting something as a table is almost completely lost. So just as a good and a bad example, maybe the bad example first. This is one of the random annual accounts I opened. It doesn't take too much of them to spot one like this, but where the table tagging isn't included yet. So on the right, you really see that figures are not yet coming through and the table layout is fully gone. One of the better examples here, on the left you see a table, on the right you also see a table. So what ESMA is not asking is that you also include the visuals like text in bold, like other items. But to be honest, it's not that important. You already have the basic information. I note we also have one question here on the monster tag. So can you still reuse the tag? So for our basic items for the ESEF here, the monster tag is still there. So the disclosure of notes and other explanatory information exists, just like a whole lot of disclosure tags that are not mandatory. You can use these if you feel that it represents it well, but it's just not mandatory. For me personally, I liked the monster tag because it gave you a representation. The financial statements or tagging responsibility is from here to there, let's say. So you can use it, but it is simply not mandatory anymore like the other items. And with that short ESEF update, we come to another, again, I'd call it a bit of a technical update, the IFRS update for items that are becoming applicable this year, but also some updates of the projects in the future. Very shortly, just as an introduction or agenda on these items, we have amendments, so basically smaller adjustments to the IFRSs on IS1, as Hans already introduced. We have disclosure of accounting policies, which we will speak about. We have IS12 deferred taxes on two different topics, a clarification we have on IS8. And then we have the really big item this year, but which we will not be covering, as you can easily cover a separate webinar on this, is IFRS 17 and the initial application of that as of this year. If you are fully in scope of that and you haven't started it yet, that would be a rather strange thing. So we won't be covering that during this webinar. After that, 2024 also has some other changes, but which haven't been endorsed yet. We'll shortly align with those. We also made a quick further outlook on some other IFRS projects, so the equity method project, business combinations under comment control, the primary financial statements project is also going to be really important. And another one, IS21, lack of exchangeability. It's also an amendment. I believe as of 2025 it will be applicable, but not a lot of you will need this one, so we won't be covering this into detail. So actually, first of the new IFRSs applicable for 2023 is very broadly applicable. I think all of you will need to look at this one closely. Actually, we can rather easily summarize it with changing one word, and that's the fact that we go from the significant accounting policies to the material accounting policy information. So that change, really important there, because you will need to do some cleanup in most of the annual accounts. Obviously, then you need a definition. What is a material accounting policy? I've copied the definition here. Accounting policy information is material if, when considered together with other information included in the financial statements, it can reasonably be expected to influence decisions that the primary user of general purpose financial statements make on the basis of those financial statements. I'll be very honest with you, that's a very general definition. That's also just a definition of materiality, but applied to accounting policies. Now, the main thing that the IASB immediately clarified in those same amendments is you can still include immaterial accounting policy information just because you think it's relevant or provides you with a better view, but it should not obscure material accounting policy information. The best example I can give you there is, for example, IFRS 9. Some of you have 3 or 4 pages of boilerplate text that are included, and then you really have to look for the information where you make a difference towards your company or entity-specific information. Anything that is boilerplate, we like it less. If it's entity-specific, I would be more inclined to keep using it. So really, a cleanup will need to be done. Obviously, I think I have 2 slides here with some pointers on what would be considered a material accounting policy. And the first distinction is actually rather important because they specifically also state just because the amounts are not material doesn't mean the policy is also not material. For example, a hedge accounting you're applying, and in 1 or 2 years the amounts related are rather small. That doesn't mean that the accounting policy is no longer material. Same goes for options or assessments of control. There's numerous options where you don't have materially visible amounts in your primary financial statements, but they can still be material. Conversely, you also have accounting policy information on material amounts, but that's actually not really changed for your company, let's say, or that's not really that material. I mean, there is some basis on recognition of expenses, but we don't have a lot of accounting policies that deal on recognition on expenses because it's simply straightforward, let's say. So here you will really need to do, and then I'm on the item 2 there, some sort of cleaning exercise where you try to throw out as much as possible of the boilerplate text. Don't throw out everything. It still needs to be readable, let's say. But if you're simply reiterating all the different definitions, for example, a accounting policy on IAS 37 on the provisions, often that's not really tailored to your company, let's say. You can pose a question, do we still need to include these basic definitions? Accounting policies will also be material if they're necessary simply to understand your financials, where you do something very different from the GAAP you're also locally reporting, just to make that clear, for example, or if it's complex. Maybe just as a last attention point here, items that we often expect to be material, if there's a change in an accounting policy, obviously, if there is an accounting policy choice, let's say, permitted by IFRS, like on how you're measuring your inventories, are you using FIFO method or using weighted average, for example, I will always expect that that is disclosed somewhere, those type of choices. But obviously, and that is always tailored, IAS 8 accounting policies that you have developed yourself, those would still remain important. Same goes, accounting policies for significant judgments or assumptions. By definition, those would be material or they wouldn't have been a significant judgment or assumption. But again, just a call to look at those accounting policies. It's not everyone's favorite section, but you will need to do some cleanup on those this year. Onto a second, I find it a rather minor amendment to the accounting policies, the changes in accounting estimates and the errors. For me, this is actually more of a clarification because what it's about is the board clarified that a change in accounting estimate resulting from new information or from new developments is not the correction of an error. That's how I already understood it, how most of it apply it. But apparently there was a need due to some diversity in practice to just stress this point. I really put it into an amendment there. So basically, if you're changing anything, we didn't know about it last year, but we're changing it and it has an impact prospectively, it will be a change in an accounting estimate. If we use a different method of measuring something, and we also have an impact retrospectively, that would be considered a change in an accounting estimate, let's say. So again, they did stress that a change in accounting estimate may affect only the current period's profit or loss or the future periods behind that one. And then the first of the amendments to the IAS 12 income taxes. deferred taxes related to assets and liabilities arising from a single transaction. Best example, if you want to follow in your thinking here, is IFRS 16, the leases. Under the current standard, there's an exemption actually for transactions in which we have equal amounts of deductible and taxable temporary differences upon the initial recognition. So like the leases, we have a right of use asset and the corresponding liability. We have an equal liability with the corresponding deferred tax asset. The text has been copied here below, and the part in yellow, at the time of the transaction, does not give rise to equal taxable and deductible temporary differences. That means the exemption here from paragraph 15, a deferred tax liability shall be recognized for all taxable temporary differences, except to the extent that we can't use that exemption for example, leases. Now, in practical, in a net presentation, this will not change your accounting as such. Just try to keep that one in mind for your disclosures when we're disclosing the nature of the temporary differences for both deferred tax assets and deferred tax liabilities. Leases would be expected to be included there on a gross basis. So we would have a deferred tax asset on the liabilities and a deferred tax liability on the right of use assets there. Then shortly, one of the very hot topics, let's say, amendment to IAS 12 income taxes, the international tax reform Pillar 2 model rules. So it's being introduced into the European Union. We also have the directive already. The amendment here was actually already published in May 2023. It is in scope of IAS 12 that has been confirmed. For us specifically, Belgian legislation is still being drafted. It should be implemented before year end, but that's not the case yet. If I understand correctly, it's on the agenda of tomorrow to be voted in the House. Let's see if they have sufficient people to vote it and to get a majority on that. Very quick mention of the safe harbor rules. That's more of a tax calculation, but take into account that you might need to provide input on the IFRS adjustment, like the purchase price allocation there. Your input might be needed to calculate this and to make life easier for the tax specialists. Why did we include this one? The new rules will have an impact on the future deferred tax assets and deferred tax liabilities. However, there's really a lot of practical questions still outstanding. It's very complex legislation. It's not easy to be sure about anything. And the current consensus there is actually to make a mandatory but temporary exemption to account for the impact of this on your deferred taxes and deferred tax liabilities. So this mandatory exemption will need to be applied to all of these, and you will need to disclose that you have applied it. A second item not to forget is if you already have some impact of this tax reform in the current year, it will always be good to disclose that impact separately in your financials, but also important, once you have some sight on what the impact will be, what your exposure is to this international tax reform, please disclose that together with a range of possibilities in your financials. Once it's substantively enacted, that will be mandatory. And it's also explicitly mentioned if you do not, or if you are not able to reasonably estimate this, then you should also disclose that fact. So you can't really get out under this disclosure requirement, let's say. Now, that's it for 2023. Maybe just also a look at 2024 and further. One of the items that's also rather important is classification of liabilities as current or as non-current. So a very quick recap on the current situation. The definition as of today and for this financial year is still that a liability would need to be classified as current unless there is an unconditional right to defer the settlement by 12 months or more. Now, there was a lot of diversity in practice here for two items. The loans with covenants, if you have to, every quarter you need to comply with these covenants, do you still have an unconditional write-in, yes or no? But also the interpretation of settlement. I mean, if there are options to settle in goods and services or an equity instrument, that tends to complicate things a bit more. Now, it's not yet endorsed, but the new amendment for 2024 on IS1 will have some more detailed guidance on this. So it will change to, you need to have a right to defer settlement at the end of the reporting date, and it needs to have substance. So basically, they have removed the requirement for that right to be unconditional. Very important distinction there. Now, specifically for liabilities with covenants, the classification criteria have been clarified. So the ISB really reconfirmed that covenants in which a company must comply on or before the reporting date, those will be able to affect the classification. So, for example, if you have a loan with a covenant, but there's data points in the future, you should not be taking those into account yet. But if you're already failing your covenants now at the moment of your closing, then it will become a current liability. The converse, they have also specified that when a non-current liability is subject to future covenants, you will need to make those disclosures. So basically, as a reader of the financial statements, you will need to make your own or need to be able to make your own assessment on those future covenants that need to be taken into account. So the information you will be required to disclose is information about the covenants, about the carrying amounts of your related liabilities, but also, do you think you will meet those covenants, yes or no? As long as you're still making those covenants and you're getting your targets there, the loan for long terms will remain as a non-current, even if you suspect that you will not be meeting your covenants somewhere in the coming 6 months, for example. But you will need to disclose that information still. Maybe some last items there that they have also clarified is on management intent. Really important there. If you have a large loan and, for example, you have an early repayment option, the fact that you intend to use that early repayment option, you might think, okay, management intends to repay this in the coming 6 months. We will need to move it to current. That is not the case. So for the current versus non-current, it's really the question, is there a right to defer the payment? An early repayment option, if it's not mandatory, you have the right, so it will remain as non-current at your end in your balance sheet. And again, the last item here, retrospective application in 2024. So if you have changes as a result from this, you will need to consider your financials, your comparatives from 2023. So it would be useful to already take these into account and see if this would change anything, let's say. Another amendment for 2024 will actually be supplier finance agreements. I've also gone through it rather quickly here. It's a May 2023 final amendment. I think most of you do know supplier financing. It's just reverse factoring, to say it like that. The definition and the amendment is actually also quite broad. So in general, you're buying goods or services from your supplier, but there's an arrangement with your bank. Once the supplier is paid by the bank itself, we will simply need to pay the amount at a later date to the bank. So basically, there's a timing difference that the bank takes care of. Now, what was the issue with those supplier finance agreements? There were some earlier interpretation committee decisions that already stated, okay, even though you're repaying towards the bank, you could still show this as part of the trade and other payables, let's say, as working capital. So there, if they're similar in nature and in function, you can still present them similarly. If they're not similar, for example, if you have completely different payment deadlines, or if there is extra security provided or other terms that differ, you can still put these into a separate category, let's say. But again, yeah, not just in the presentation of the balance sheet there, you also have some problems in your cash flow statement, financing versus operating, in the notes and disclosures of liquidity risk, etc. So for that, actually, we're having an amendment to IAS 7 or IFRS 7 on these supplier finance agreements. Now, just in very broad terms, there will be general disclosures, again, requirements, and those are terms and conditions, the amount of the liabilities that are part of those arrangements, a breakout for those suppliers who have already received the payments, where the amounts are standing in your balance sheet, ranges of payments, due dates, liquidity risk information. So here, to put it just very broadly, the full supplier finance arrangements will be described as a full transaction with all relevant facts and circumstances in your financials. So there's no hiding, there's no obscuring things. Let's say you simply need to put everything in there.
There was one question on whether you can apply the amendment of ES1 as early adoption because it's not yet adopted by the European Union. The EFRAG indicates that it's expected to be endorsed prior to 31st of December 2023. So let's hope they will adopt it prior to Europe.
Yeah, actually but that's a personal opinion, let's say. But if everyone fully expects that it will be adopted, and that is simply a legislative process, but it will be adopted sometime in the coming year, I don't think it makes sense that for just that reason that you would not adopt it. I mean, if you look at it from an enforcer's point of view, would they really come asking you questions? Why have you adopted this reasonable thing that we have voted for, simply because it's not yet in the legislation yet? I think that would be a rather difficult question for them to pose. But again, it's technically possible, but it wouldn't make a lot of sense from an enforcer's point of view to go into those technical details there.
You could consider it as a substantially enacted.
Yeah, something like that. Other IFRS project updates. So here, actually, I wanted to go a little bit broader into some other projects that are running. One, actually, a few weeks ago, there was a vote and it has been discontinued, but that doesn't mean that it's not useful to know that it was ongoing. It's the project on business combinations under common control. So it's more of a related party transaction. Let's say if you have a group with a consolidation perimeter and you're acquiring another entity which was already under control by the same person who controls your group, that common control transaction would typically not be part of the IFRS 3 scope. Now, the project was intended to fill a gap because there's currently no clear guidance on that. There was a discussion paper that was published, a lot of stakeholder feedback, but actually there were no clear agreements that they could make as a result of this feedback. So if you ever have this case, just know that there's quite some discussions and some insights on that, on the book value method versus the acquisition method, and how and in which cases you can apply these. Now, they also consider, do we need to make this a disclosure project only? Scrapping just the accounting measurement, they decided against it because it doesn't fill the gap. It's a little bit of a strange decision because they acknowledge there's a large gap for guidance to be filled here. What they did reiterate is it's not that there's no guidance, there's something available, but you will need to apply IAS 8 if you have one of these transactions, let's say. Second one is actually still rather in its early phases. It started as a research project, and now the equity method project has actually been moved upward towards the next step, the setting work plan. So the next plan, somewhere in next year, they plan to publish an exposure draft, including some of the tentative decisions that have been made already by the board. So very shortly, gains and losses from transactions between a company and its associates. Sometimes those are recognized in full, sometimes only for the amount you don't have an interest in. It will be clarified there that the new standard is to recognize everything in full. There will also be more specific guidelines on how to account for acquiring additional interest in those associates. So if you go from, for example, 15% to 30%, how to recognize that in your carrying values, but also especially more disclosures on contingent consideration arrangements. So what part of your cost is included there, descriptions, other details, what is your range of outcomes, and then throughout the next years and your subsequent periods, how those amounts have changed, how those range of outcomes have changed. During the project, they also noted that, okay, we started at this as a research project for the associates. Actually, we can apply this broader to other investments, such as joint ventures also. So the project scope will be broadened some more, but I'm looking forward to the final exposure draft that will be published somewhere in the course of next year. And then maybe the last two items I want to touch, projects in the balloting phase. So apparently they do have a balloting phase. It's more of an internal review, let's say, drafting, reviewing a approval process to make sure it is up to standard. But those are the ones that they have in the pipeline, let's say, to become public in the next year. Two projects where exposure drafts are in this phase. The second one we will not touch, but I will mention it here. Financial instruments with characteristics of equity could be quite useful. But first one, business combinations, disclosure, goodwill and impairment. It's a much debated item. Not much changes, but still an ongoing heavy discussion, let's say. And then also, and that's rather new also, decisions from November 2023 are actually the project on primary financial statements, which I will tell you some more about. So the first one, business combinations, disclosure, goodwill and impairment. The top two sentences are actually input there from the stakeholders. Investors want to have better information on how acquisitions are performing, and they want to keep management to account on how they are performing on that acquisition. Now, it's actually already an older decision, but last year they voted against changing the basic rules of this. There was some options to reintroduce amortization of goodwill, but it has been voted against. So there was a very narrow majority to remain with the impairment-only model, mainly because amortization periods are also highly judgmental. Another thing that they might change, it's not certain yet, so we're looking forward to the exposure draft there, is they might change towards trigger-based testing for goodwill also. So no longer a yearly mandatory test, but only when there are impairments. For me personally, that's a bit strange, because if there's a risk that your goodwill is overstated on the balance sheet and you ask even less impairment tests, that risk will become even higher. So it doesn't make a lot of sense. I'm really looking forward to the exposure draft here to see how they intend to remedy those issues. And then as a last big new item, it's actually, you may have heard about it, the primary financial statements project. It's a long way off. Its effective date as of 1 January 2027, but actually it will already be published somewhere during the course of next year, or it's intended to be published then. The new standard will be replacing the IAS1 standard, presentation of financial statements, and it will be focusing on communicating the financial statements with a heavy focus on changes in information in the profit or loss. I think if I go to the next slide, that will become more clear, because categories and subtotals, one of the three big changes they will make is actually the introduction of categories to provide a consistent structure of the statement of profit or loss. So we will be having operating, investing, and financing as categories for your profit and loss statements. And together with those new categories, we will also be having 2 new mandatory subtotals that will enable more analysis. The operating profit or loss, some of you already use it, but sometimes slightly different, and also profit before financing and income tax. So the last one, that should actually give you a picture of the company's performance, but just before the effects of the financing itself. I've included from the IFRS Advisory Council the slide they showed there. So here you can see the operating items. I think that's not really a change for most of us. The operating profit as a subtotal will become mandatory. And then, yes, share of profit from associates and joint ventures, gain on disposals will be investing, let's say. So really, for most of us, these won't really be any big changes, except for the subtotals and maybe the order in which to present, let's say. Second big item on the IFRS 18 will actually be management-defined performance measures. As Hans already introduced, the guidance here is very, very similar to the current guidance on alternative performance measures. So it intends to fill that same gap. So actually, we will need to present all the same items in a single note. So a statement that the management-defined performance measures reflect management's view, an explanation of why you use it, reconciliations back to the IFRS numbers, and explanations if there are any changes. You need to be consistent. So I've included some examples here, but usually there's quite a lot of these. So yeah, it will be relevant, but it shouldn't change too much in practical terms for you. And then also, I haven't included much details on these because there's quite some discussions on the sweeping issues there. But grouping, so aggregation and disaggregating the information, there will be more and detailed information in the new standards, more than there is currently. But it should also have additional information on what do we need to include in a primary financial statement, what do we need to include only in the disclosures. So that's a gap that is currently not filled in IS1, and some extra disclosures necessary about other items. So yeah. That's the last big item I wanted to mention on the primary financial statements. Thank you, I think, for staying with us on the full webinar on a rather technical topic or multiple technical topics. Thank you for your attendance in the other webinars this year. We don't really have any other webinars planned during the first month of 2024, since everything is usually busy, but towards the half year, let's say, look towards our website. More information on the upcoming webinars will follow soon there. We wish you a good start of the new year and enjoy the Christmas holidays. I'll look towards my colleagues. I'm not sure if you have any other questions there.
No, no further questions.
No further questions. Okay, then I think you can wrap up here. Thank you for your attendance.